Hello, everyone. Thank you for joining today's webinar, Finding Alpha from ESG 2.0 Factors Beyond the U.S. I'm pleased to introduce today's speaker, Stephen Malinak, the Chief Data and Analytics Officer at Truvalue Labs. Stephen leads their quantitative research team in applying artificial intelligence and machine learning techniques to create new financial signals from unstructured data. An industry leader in quantitative analytics, Stephen joined Truvalue Labs from Thomson Reuters, where he spearheaded the company's quantitative analytics offering, StarMine, and developed over 15 quantitative models. He has an extensive track record of successful predictive models using widely varying techniques across numerous domains. Stephen attended the Massachusetts Institute of Technology, where he received his degree in electrical engineering and computer science. He then went on to receive his master's and PhD in engineering economic systems from Stanford University. On top of that, Stephen is a former QuantCon speaker, and we are very happy to have him here hosting a webinar for us. Thank you, Stephen.
Great. Thank you very much for the introduction, and thanks to all of you for attending today. Motivation for this talk is, I've spent a lot of time looking at different quant signals since around 2006 and went through the traditional data that's available for value, momentum, quality, analyst revisions, a lot of the typical factors that are out there. And what I've spent the past few years on is how do we find new data sources, new pieces of information that aren't necessarily already incorporated into people's processes. And have definitely found that getting a new piece of information that gives you a new angle is going to be a lot more productive than trying to massage the same fundamental information that so many people are already looking at. So this is a story of how we go about creating new factors, in this case on environmental, social, and governance information coming from text. So I'm going to spend the first part here on how we actually go about creating this information. This is just an example of a piece of alternative data that's out there. This area is growing explosively, and it's something you definitely want to think about in terms of incorporating into your models. So you could use things based on text, you could get things based on sensor information, credit card transactions. There's hundreds, even thousands of providers that are sprouting up. Then once we've explained where the signal is coming from, I'll show some initial attempts to use it in a screening process that worked pretty well, but left some holes in the typical quant approach that we were then able to fill by digging into how the signals work in more detail and showing how you could actually score an entire universe of companies, including those where we had low coverage, and then how that is successful in combining with other quant factors. So to begin, where does this information come from? Here at Truvalue Labs, our goal is to get long-term information on the sustainability of a company focused on environmental, social, and governance signals. And we're getting it from third parties. We're not looking at what the company has to say about itself. We're looking at what other people have to say about a company. So we're scanning many, many different sources over the internet, including some paywall information that we have a license through providers such as LexisNexis. And there are other ESG signals that are out there, many of which you're probably familiar with. Companies like Thomson Reuters, MSCI, Bloomberg, Sustainalytics, and some others. They are greatly focused on company disclosure. So it's based on policies, things that the company says about itself. They will do some independent research into controversies, but it's mainly focused on the company's perspective. What we're doing is trying to explain what's going on from an external perspective. So for example, BP had a huge incident with spilling oil into the Gulf of Mexico. That wasn't heavily discussed in their own disclosures and policies. If you wanted information about that, you would want to see what's going on in the local news and what environmental experts were saying about such things. So you can frequently get a very different perspective from outside people. We're using the SASB framework here. This is the Sustainability Accounting Standards Board. And because these are such important issues, this group got together several years ago. Many well-known people, such as Michael Bloomberg, actually part of the organization. And the goal is to get companies to start talking about material issues that are outside of traditional financial statements. So you've got, business model, governance, environment, human capital, social capital, some very specific things like data security and customer privacy, along with typical issues like air quality, labor relations, product practices. And we can actually get a signal on each of these topics. And we've worked closely with SASB to figure out how to train machines to look for this information. So we're going through many, many different sources to tag articles on each of these topics, and then figuring out what the company is doing to make things either better or worse in these areas. So currently we're covering about 9,000 companies. They tend to be large and mid-cap. We're pushing that out to include small cap companies in countries that speak English as their primary language. So we've got excellent coverage in the US. We're pushing out small cap in Australia, Canada, Hong Kong, Singapore, UK, South Africa, other places where English is very heavily spoken. We're drawing from many different sources on the web. There's actually over 100,000 of them. Local, national, international news, NGOs, trade journals, a lot of people who are specific experts. We're not mining social media in general. There's any number of providers who are looking at social media. We're using Twitter to follow a couple thousand thought leaders who are known experts in these areas, and then following links to long-form articles in a journal, something like Hazardous Materials Weekly or some data privacy journal, and then you look at the long-form text there. So we're going through a lot more data points than we're actually using at this point because we're honing in on ESG signals. As time goes by, there's a lot of other event-driven information we could start aggregating as well. But at this point, we actually have 11 years of history on all these companies, and it's something that can definitely be incorporated into a quant backtest. And I've had good success uploading this onto Quantopian, combining it with other kinds of factors, running it through the Quantopian risk model, seeing what the exposures are, and places where this is particularly additive. So it's a fairly complex process. It's not just, one set of programs or, one neural network type thing. We go through a whole process to aggregate the information. We've got a team of about 10 people on our data team who are looking at sources and verifying that this is legit information that's coming in, maintaining blacklists for publications like The Onion that are directly putting out satire. We don't want to be processing that. Then we need to extract the text. A lot of the work that goes into these types of systems is getting the actual meaningful text and stripping out ads and links to other articles and videos and other sorts of things that show up in your text sources. You also want to get rid of boilerplate things that companies are saying about themselves and make sure you really want to get the key information in there. We need to figure out who's the entity that's being discussed, because this isn't company reported. We need to understand that this is about Amazon and it's not the Amazon rainforest or Amazon river. So that takes a while to work out. You need to understand all the corporate actions and entities. We need to categorize each of these signals. What's labor relations? What's child labor? What's not child labor? And then once we've identified those topics in companies, it's relatively straightforward to score the sentiment and see if people are improving the environment or deteriorating the environment. And we generate a whole series of analytics off of these. I won't go into all the details of what's available, but the key thing is we end up with 4 time series on each of these topics. So for example, if you take air quality, there'd be a pulse score, which is the dotted line here that can go up quite a bit day to day. Is this good news or bad news coming in? It's meant to be a very short-term signal responding to what's happening as it comes in on a day-by-day basis. Now, because that moves very quickly and people are often investing for the long haul, you need something that's going to smooth that out over time. So we created what we call an insight score. It is literally an exponentially weighted moving average. Formula for that fits on a Post-it. It's just looking back and weighting things according to time. So something 6 months ago gets half the weight, 12 months ago gets a quarter of the weight, and so forth. And this provides you a long-term time-weighted rating equivalent that you can compare to what you would see from some more typical ESG type information, particularly if you put it on an industry percentile. We also look to see if that longer-term score has been going up or down over time. We call that the momentum score. It starts with the slope, and then we rank that across the universe in different industries to see who's really going to be upgraded and who's going to be downgraded. And then the last piece of information is this volume score, which can spike quite a bit, as you see. This is not trading volume or sales volume. This is the actual volume of data that we're getting. So it's literally the number of articles coming in on a company. So the smallest bar you would see there would be 1 article, twice as much as 2 articles. And we can actually see very large spikes up to hundreds of articles on these companies can be coming in on any given day. And one thing that really makes this different from other factors is we need to incorporate that volume information in what we're doing. That if you've seen one article in the past year, it's very different than if you've seen thousands of articles. So one of the challenges here as a quant is how do you incorporate different amounts of information that have different strength behind them, essentially, and what can you do with that? We also have these time series on each individual topic and on the overall score, and on something SASB calls materiality, which is their view of what's most important on an industry basis. What I'm going to talk about in here is largely going to be focused on our overall signal, and that's using the data volume to weight what's most important on a company-by-company basis. So if 60% of what we're seeing coming in on Facebook has to do with data security and customer privacy at this point, then data security and customer privacy would get 60% of the weight. That said, it's possible for customers to take these and reweight them however they see fit, because we provide the individual scores as well. So let's go into some things that we can do with this data. And the first approach is to say, well, let's just look for the best companies and form a portfolio based on them, or find what are the worst companies and screen them out. For starters, we're actually using an official index here. This is ACWI, the All Country World Excluding US. We already had some US results, so we wanted to see how well does this work outside the US. And particularly, we want to understand how it's working in English-speaking countries versus non-English-speaking countries. So one interesting observation is that, this index is publicly disclosed through an ETF. The ETF is literally ACWX, and you can go back month by month and figure out what's in it. And this is, I believe, as of May of this year. And interestingly, the first 3 countries in this index are Asian. We've got Japan, China, and Korea. Then you've got UK coming in after that, and a lot of the G7 countries. So some of these are English speaking, some of them are not, and we'll look at how that works out as we go through the data. The composition of this index has also changed quite a bit over time, that many of these Chinese companies were recently added. So it's particularly interesting to see what's the evolution over time. Not surprisingly, data availability is different in English-speaking versus non-English-speaking countries. Now, this will change as we progress. Next year, we're looking at adding Japanese, German, and quite a few European languages, and then eventually Chinese and Russian, Arabic, and so forth down the line. But if we start with just the English-speaking documents, we have those even in places like Japan. We use the English version of Japan Times. In English-speaking countries, we see high data volume in about 1/3 and medium data volume in about 1/3 as well. High is something every 2 weeks or more frequently. Medium is more than once a quarter. Low is less than once a quarter. And none, we've literally found nothing on that company in the past 12 months. So an English-speaking country is only 15% of this index. We find nothing. In the non-English speaking, it's closer to an even distribution across these 4 categories. So about half have higher medium volume, half have low or no volume. But it turns out there's actually a signal in this data availability as well. First of all, if you have a lot of data availability, you're more confident in what's going on. So our first quick screen is we took just the top half of companies, and we did this on a country-by-country basis to normalize for differences in information availability. And then within those top half, we binned on our insight score. This is the slower moving signal of ESG aggregated up. And we see that it does do a pretty good job of ranking companies. The top 6, we did 6 instead of 5 because we've got a 3x3 chart in the product, and so it naturally came in multiples of 3. There's no particular reason other than that. The top ones are going up about 4.5% faster than the index. Interestingly, the bottom ones are also going up faster than the index by about 3%. And the reason for that is that there's a very strong small cap effect in this particular index. And if you even weight, you can quite strongly outperform. So actually, the even weighted version of ACWX is going to outperform by about 3%. So that 4.5%, a good part of it is coming from the even weighted, and the rest of it is coming from the ESG signal. So you could here form a portfolio using just the high ESG companies on strong data volume, but that's not going to necessarily score everybody. It's just going to help you hone in on where you have the strongest positive information. That said, if you use this as a screen, you can get something that outperforms quite handily. This index has actually struggled over the past 10 years. If you look in February of 2016, it was still below where it had started back in May of 2008. So even this information gives you a pretty strong edge. And if you take the ones with high ESG and high volume, you get about 2.5 times the return over this particular 10-year period. So when we started going over this with a lot of people, we got many questions on, can we increase the breadth of our coverage? What do we do if you've got low or no information? Is that usable? The low information is certainly usable from a fundamental analyst perspective, because they can go in and read the individual articles. But for a quant, what do you do with that? Can you score the whole benchmark? How do I combine this with a factor that scores the whole benchmark? Is there something that gives me a more linear response? And how do you deal with, short-term and long-term opportunities? What do we do on the short side? So many questions. We went back to the various data signals and said, all right, is there a different way that we can combine these that helps address these questions and combines more naturally with the more typical quant factor? And the first thing we found is that the data volume itself is super interesting, and it goes in the opposite direction of the size effect. So if we look at this particular index, ACWX, and we find the smallest companies in that index, now these aren't really small cap, they tend to be more mid cap, but they outperform very substantially versus the largest companies to start. So on the left side here, Q1, smallest trading volume, and here we've used trading volume to rank them rather than market cap. I'll get back to why in a minute. That group of companies outperforms by 12%. If you split that gray bar into two pieces, the purple one is the half that has the most data volume in that set. The blue one is the half that has the least data volume. Those with more data volume are outperforming by more than 16%, whereas those with less data volume are outperforming by only 10%. And you see similar behavior on most of these groups. Even going to the most heavily followed companies, the ones with significant data volume are about keeping even with the benchmark, whereas those large companies with low data volume are actually trailing by a half or almost a whole % per year. So this is something that does persist across the spectrum, but it's particularly a big deal on smaller companies. Now, we looked at a few measures of size. Market cap was the first one that came to mind, and if you bin companies by market cap, you see this tremendous spread. There's actually 14.7% quintile spread solely based on market cap. We looked at dollar trading volume because it's not perfectly correlated with market cap, and it's probably a better proxy of news information that you'd see on a company. We definitely see that trading volume drives news flow as journalists want to understand what's causing this large amount of trading volume. And we also see that news flow drives trading volume because when there's information on a company, it's going to cause people to go long or short and generate a lot of activity. And the trading volume actually has an interesting price response in and of itself. When you look at correlations, the trading volume and market cap are correlated about 0.5. So there is still a strong correlation there, but not as much as if you were loading up directly on market cap. And we didn't want to bake market cap directly into this signal because that's something that many people are using as the actual size factor itself. And I haven't seen a lot of heavy use of trading volume as a quant factor by traditional equity quants. It's something that a lot of trend followers will look at in the commodity markets. And certainly people who are doing technical models, if they see a breakout on a large volume that has a signal in it, but that's something that doesn't typically get incorporated by people who are looking at fundamentals and value and quality. So this helps introduce another new piece of information that's readily available that people aren't typically incorporating into their process. Now, if we want to combine these two, we found that more information is better. So this activity rank is how much data volume you see relative to trading volume. And then a higher ESG score is better. So that's this insight rank. And the top right is where we had been running a screen earlier, that we want companies with lots of data and high ESG. It turns out the ones that you want to worry about are the ones in the bottom left, actually, where you have a small amount of information, but what you find is bad. If you look at the bottom right, that's a company that's had a very well-publicized ESG issue. And often by the time that everybody is talking about it, this is already priced in. And let me give you a very specific example of that. This is a screenshot from our desktop offering. And we're looking at Equifax, which is a credit rating, consumer credit rating agency. And it was very quiet for a long time. And then all of a sudden they had this data breach, and there's this massive output of data volume where everybody's talking about this company. And the stock prices here in purple, it crashed significantly within about a week. And our short-term indicator dropped very quickly as well. So, you know, if you were interested in shorting, you could jump on it, but you see about half of the price movement happened there in that first day. So you've got to really move fast in a situation like this if you're trying to short this company. If you're a longer-term investor looking at months or quarters, you know, by the time your long-term signal reacted, the price had actually started recovering. And this is pretty common. If you see a company that has a crisis that does not put it out of business and handles it reasonably well, the score eventually starts moving up, as we see on the far right here, and the price recovered as well. So you actually might be interested in this as a buying opportunity from an ESG perspective because you had an overreaction. You can also screen these out entirely if you want, you know, pure ESG and don't want to get into companies that have had any controversies. You can sidestep those as well. So an example of a place where we see trouble brewing, this is POSCO Daewoo in Korea, and we did not find many pieces of information about this in English, but what we did turn up were two articles. First one, headline, Dutch pension divest from Korean firm over deforestation. And the second one says, in Indonesia, this Dutch pension fund divests from Korean firm because of forest destruction for palm oil operations. And those of you who are into your environmental issues and palm oil in particular know that this is a major hot button issue, and anybody who's into long-term sustainability doesn't want anything to do with that palm oil business. And that's enough to keep it out of your portfolio from an ESG perspective. And we see that sure enough, the price has been dropping on this thing for other reasons. So these are the companies that you are particularly concerned about. And if you think about, you know, some of the old trading sayings, you hear things like buy the rumor, sell the news, or in this case, sell the rumor, buy the news, that if you want to short something in the longer term, you need to get on that well before it's something that has heavily entered the public consciousness. And once everybody finds out about the issue, that would be your opportunity to buy it back. So if we put all these pieces together here, we can construct a composite signal looking at the trading volume, the data volume, and the insight rank, which is our slower moving signal. So on the left, we see quintiles of insight rank. You'll notice this time, the bottom one has actually jumped up a amount, and that is because we have not screened this on data volume. We've included all of the scores here for insight rank. And we find that a lot of the low volume ones are kind of noisy, and we do find some bounce back from crises. But there is definitely a signal there. The ones to the left are doing better than the ones in the middle. The middle set of bars is based on our data volume versus trading volume. That's actually the strongest signal from a quant perspective, that the top quintile outperforms the bottom quintile by about 7.5% annualized with monthly rebalancing. So if you're just looking for a new quant signal, you could just use that directly. But if you want to incorporate the ESG information as well, you could cascade these together. So what I've done is I've just multiplied the ranks and then re-ranked them. And on the right, you get your ESG activity signal. So that's split into 5 bars, where the top bar has got the most and most positive information. The bottom bar has a combination of least and negative information. So you would want to focus on the ones that have got strong positives and stay away from the ones that have got weak negatives. We see a quintile spread here of 5.8%. Again, the reason that they're all outperforming is because of the even weighting. So those 2% ones would actually be below the even weighted average for the index here. Here we see an even stronger price response. if we take the top quintile, you're seeing pretty significant outperformance versus the benchmark. And interestingly, it's coming from the upside here, that when the market is moving up, this is latching on to stocks that are doing particularly well, and you're not really getting hurt in a bear market. It's kind of hard to tell from what was going on way back in 2008 because we didn't have really strong data availability. You might want to look at, how we're doing over the next few months. If we're going into another of these periods, we'll see some more interesting volatile activity going on. So how would you combine this with other signals? What else can you do with this information, and how does it compare to some other things that people would be looking at on this benchmark? Well, the first thing I wanted to do is to take a typical smart beta type approach. I've picked 5 factors, in this case, size, price momentum, minimum volatility, value, and quality, put together basic signals on each, combine them, re-rank them, and you get something on the left here that has a quintile spread of 9.1%. The ESG activity signal by itself has a quintile spread of almost 6%. And when you put the two of them together, it does help at both ends of the distribution. So the top companies go up more, the bottom companies go down more, and you see something that is additive to your spread overall. And we see it definitely helps with certain areas more than it helps with others. So I wanted to do a bit of a sensitivity analysis here. First thing is looking at English-speaking versus non-English-speaking countries. And we definitely see better performance in the English-speaking countries. That top quintile is going up by about 9.5% per year versus the underlying benchmark. But we still see top quintile 6.4% in the non-English-speaking countries. So we're definitely getting a signal both from the amount of information that we get in English sources, as well as is this a strong ESG or strong negative ESG company as well. And we expect that as we add other languages, we'll start to prop up how we're doing in the non-English speaking countries. It's interesting to see that now that when we look at high data volume versus low data volume, we've got a signal in each of these. So the first approach we looked at, we literally just took the top half of data volume and sorted those and had no signal at all on low data volume. Using this combination factor, we've got a signal on each. The quintile spread is actually slightly higher on the low data volume companies. And the reason for that is the ones that do struggle are those that have low information and are still in rumor state, whereas the high data volume ones, they're less in a rumor state, and you're actually more in the bounce back in that bottom quintile. But from a positive perspective, you definitely want the highest data volume and the most positive information. So if you're looking for something long only, you would again want to take that top quintile in the high data volume case. But we've created a signal here where we didn't have anything before by looking at this combination of data availability and how positive or negative the articles are, even in the low cases. One thing that I found particularly interesting here is how this does on growth stocks versus value stocks. It's often hard to find quant factors that work on growth stocks, where growth here is defined as not value. So I took the universe on earnings to price and split it in the companies with high E to P or value stocks, companies with low E to P or growth stocks. Price momentum will tend to work on growth. Analyst revisions can help with growth, but value factors don't have any idea what to do with it, and often quality factors don't either, because these growth stocks are not trading on value. But what they are trading on is stories. These are literally story stocks, and people are talking about why it's such a great company. And a lot of what is propping up the valuation is intangible value. And it could be that they've got strong management, strong ESG. They're doing something to improve the environment. I mean, we see some tremendous stories in this database. People are taking floating mountains of plastic in the ocean or medical waste and finding ways to recycle the stuff and turn it into cheap energy and reusable products. And these companies are growing very rapidly and trading at just tremendous valuation multiples. So when you look at stories and sentiment on these topics, you can get something that does a really good job of sorting growth stocks and is additive to a lot of other factors. We also get asked about, well, is this just picking certain sectors? Does it have biases in it? It definitely has some biases in it. It likes tech, it likes healthcare. I'm not a big fan of coal companies and large polluting industries. That said, it is doing a pretty good job of picking within sectors. So here I've given 3 different ways of doing the ranks. The one on the left is a global rank that just throws everybody into a pot and is free to pick across countries or sectors. The one in the middle is the country rank, and that's what I've focused on in the presentation up to now. I think that makes the most sense here because we're dealing with different languages and different exchanges, so you want to do things within a certain country. If we let it pick only within sectors, so it compares utilities to utilities, it compares consumer discretionary to consumer discretionary, we still see a pretty good ability to sort stocks, but you lose some of the performance. And this matches what I've seen with a good number of other quant factors is, roughly 1/3 of the value comes from picking sectors correctly, and 2/3 comes from picking within sectors. And we're seeing something kind of similar to this here. So that was an overview of the whole process, how we started with a new piece of information. We went through text from third-party sources, looked at 100,000 sources, categorized 9,000 companies on 30 different SASB factors, created 4 different time series that go back 11 years, looked to see how you could create screens off of those, how you could create quant factors off of those, how they worked in English speaking versus non-English speaking, and how they actually helped add to some other quant factors that are out there. So hopefully this gives you some ideas on some new information that you look at and maybe some more creative ways of combining pieces in new ways as well. And with that, I'm happy to take some questions. Okay, so some questions. How can we use this data source on Quantopian? So this is not something that's currently up there and readily available, but it is something that can be loaded as proprietary data. So our firm, like many others, will make data available for trials, and people can take a look at it and see how it works in their trading process. And this is how we work with quants around the world. They're able to load it as prop data. Next question, how do we make sure the signal's not too overfit or look ahead bias? So part one is we didn't train it on price at all. And that's something that I normally go into in some detail. There are a ton of people who are using artificial intelligence and machine learning, and they're data mining based on prices. And I'm not a fan of that approach. I've seen people make presentations at trading conferences where, a guy comes in and says, well, we're going to use genetic algorithms to look at 90 days of corn price data on a minute-by-minute basis and run millions of iterations to figure out the optimal trading strategy. There's no way that's working out of sample. If you train something on a small amount of price data and keep running it, it's going to find the perfect path through that history, but all it's done is memorize the history. So because there's so many things that can drive the price of a company, we find it's better to train on a signal with a much higher signal to noise ratio. So, in the past at StarMine, we focused on analyst revisions, and we're looking at analysts' ability to predict earnings, which was way better than their ability to predict prices. You can look at ownership information and how that predicts fund ownership. In this case, we're looking at using machine learning to find text on topics. So the concept of child labor doesn't change very quickly. The language around it is pretty steady. You do see some new concepts that come in like #MeToo. That wasn't something that was discussed a decade ago. Fracking is something new that came in. It's a whole new word. But in general, the language is pretty steady. So the whole artificial intelligence part was fit to finding the topics and finding the sentiment around that. The entire testing on a stock universe was after the fact. So one view is the entire thing is out of sample. Now going in and picking parameters like, do we want to use the top half of volume or what buckets of insight? And, I'm not too concerned about saying something like top half of volume. It doesn't really matter if it's 40 or 60%, or even the top 80% or bottom 20%. If you've got something that's a fairly linear factor, then you feel better about its robustness. And, when we were testing StarMine models, we would slice and dice the universe many different ways, look at different countries, up markets, down markets, correlations with various factors. How does it do in different regimes? How does it do in different industries? And the more robust you see a signal is, the more confident you see in how well it's likely to work out of sample. Okay, next one we've got is correlations with other factors, value, size, momentum, reversal, so forth. Here's a case where the Quantopian risk model is actually quite helpful. We ran it through, sorry, I didn't include that slide in this particular presentation, but it was in the work that I did at QuantCon. There's really no correlation with price information. You see some spurious correlations with long-term price momentum, but it's positive on one swing and negative on another. It averages out to zero. No correlation with the short-term reversals. Value was particularly interesting because there is a fairly strong negative correlation with value, and that was something that we like quite a bit. It's in the nature of ESG factors to start with. Value loves cigarette companies, coal companies, broken down industrials of various sorts. Often these are very profitable companies, but they might be polluting or having side effects or other ESG type issues that aren't included in that value factor. Whereas what we're seeing is these companies that are doing really well on environmental issues or governance or access and affordability may be trading at high multiples. And we see that ESG actually helps prop up the multiple of a company. Many other people have found this as well. And as a company improves its ESG score, its multiple will expand. So this is great in that it helps you sort stocks very differently from a common factor. We saw some similar kinds of results with min-vol. If you look at size or trading volume, we showed that actually our data volume goes in the opposite direction there. So again, it's got a negative correlation and it's additive to that factor. So I believe that covers the questions that have come in. If there aren't any others, then I think we can call it a wrap.
Yep, that's all the questions we've gotten, but if you think of a question that you have for Stephen and you want to email it to us at events@quantopian.com, you definitely can do that, and we will make sure he gets a hold of it. On behalf of Quantopian, I'd like to thank Stephen once again for hosting a terrific presentation. So thank you all for joining, and thank you again to Stephen, and everyone have a wonderful day.